Right now, gold looks like it skipped straight to paranoia. Gold just blasted past $2,400 an ounce, up more than 20% in 12 months, while stocks are near all-time highs. The dollar is strong, and rates are still above 5%. That's not supposed to happen. Gold is acting like someone pulled the fire alarm at a party that's still raging. So, what DF is going on?
This isn't the first time gold has done this. Let's rewind to the 1970s. Inflation explodes. Oil shocks. Trust in government? Not great. Gold goes from $35 in 1971 to $850 by 1980. That's a 24x move in under a decade. Why? Because Nixon closed the gold window in 1971. The dollar stopped being backed by gold, and suddenly, money printer go burr. Sound familiar? Fast forward to 2008. Financial crisis. Banks wobble. Fed cuts rates to zero. Launches quantitative easing, aka liquidity flooding the system. Gold runs from $700 in 2008 to $1,900 by 2011. Different crisis, same emotion. Fear of currency debasement. Fear of systemic risk. Gold thrives when trust dies. Now here's the twist. We don't have a visible crisis. Stocks are booming. Unemployment is low. GDP is growing around 2 to 3%. So why is gold behaving like it sees a ghost?
Let's meet the villain. It's not inflation. It's not retail investors. It's central banks. In 2022, central banks bought 1,082 tons of gold. That's the highest level ever recorded. In 2023, over 1,000 tons again. China alone has added gold reserves for 16 straight months. Russia's been hoarding. Emerging markets are diversifying. Why? Because the dollar is powerful, too powerful. The U.S. weaponized the financial system in 2022 by freezing Russian reserves. That was a wake-up call. If your reserves can be frozen, they're not really yours. So what's the alternative? Gold. No counterparty risk, no SWIFT system, no sanctions, just a shiny rock that's been money for 5,000 years. Meanwhile, U.S. debt just crossed $34 trillion. Interest payments alone are running above $1 trillion per year. That's more than the defense budget. And here's where it gets weird. Real interest rates, adjusted for inflation, are positive. Historically, gold struggles when real rates are high. Yet here we are, gold at record highs anyway. It's breaking the old playbook. That's why people are confused.
So, what does this mean for you? Let's zoom out. The Magnificent Seven now make up roughly 30% of the S&P 500. AI hype is real. Valuations on some of these names are pushing 35 to 45x earnings. This feels less like 2008 and more like the late stages of something crowded. Gold isn't competing with tech. It's hedging against the system. It's insurance. And here's the key shift. For years, gold was driven by ETFs and retail flows. Now, it's driven by sovereign strategy. Governments are quietly reducing dollar exposure. Not because collapse is imminent, but because concentration risk is obvious. It's portfolio management at the geopolitical level. That's new, and markets feel it.
So, is this the end of the dollar? No. The dollar still makes up about 58% of global reserves. There's no real replacement tomorrow. Is gold going to $5,000 next year? Also, no idea. Anyone who says they know is selling something. Here's the balanced take. Gold is sniffing out structural risk, debt levels, geopolitical fragmentation, long-term currency dilution, but it's not predicting apocalypse. It's pricing uncertainty, and uncertainty is permanent. The smart move? Don't panic buy. Don't dismiss it either. Think in terms of allocation, risk management, optionality. gold isn't a bet on the end of the world, it's a bet that the world stays complicated. And if history has taught us anything, it always does.